Back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's my pleasure to welcome our friends online around the world, as well as those with us today, for our 99th semi-annual Global Economic Prospects, or rather, it's not actually the 99th, but it has been going on for some time, and I want to take a minute to talk about what we've done in this format and some of the calls we've made before turning it over to the people you really want to hear, Karen Dinan, Jason Furman, and Monica DeBola. So we've been running this for a while, actually since '06, and our plan is always to release our independent set of forecasts roughly a week to 10 days before the IMF releases its WEO. We are less politically constrained than the IMF and also less model-driven. This allows us to focus on particular points where the market consensus or the official consensus seems to differ. We always focus on the US and the global growth outlook at a 2-year horizon and release that, but we also always do 2 special topics. The hope is by talking about turning points, data interpretation, and some political economy, we talk about a balance of risks in a way that others do not so much to differentiate ourselves, but to be a contribution. This effort is now led by Karen Dinan, and ramping up, I think it's really going to be Karen Dinan and Jason Furman, since they have offices near each other and shared resources and shared worldview at the Kennedy School, and we're very grateful for that, and I'm still playing a role. But we draw on the entire Peterson Institute for International Economics team to put together the forecasts. And obviously, this was previously led by Mike Musa and by David Stockton, who we already had sort of the passing of the torch from him to Karen a year ago. I'd like to point out, since I had Dave take this over in 2012, some of the notable calls we made that turned out right. One was me in 2012 talking about the euro area being a sudden stop, not a fiscal problem, which others have picked up on. Dave was out in front in April 2013 talking about no US inflation threat. I know it's hard to imagine now, but if you put yourself back 5 years ago, there were an awful lot of people talking about imminent hyperinflation, and Dave helped kill that. Jacob, importantly, as many of you know, Jacob Kierkegaard had a different view on European cohesion, and that you would manage to have no breakup of euro area from Greece or Italy, and that, of course, proved correct. Another thing which Dave Stockton did for us over the last couple of years was make a very accurate forecast of ongoing US recovery, but never assuming that it was due to an investment boom, and talking about investment lagging the recovery. And I think that was the right call, and obviously a turning point was reached. Simeon Jankov, who's on leave from us right now working at the World Bank, had already flagged from his unique perspective how the rise of nationalist parties in Eastern Europe were going to start weakening the EU initiatives and weakening growth back in October 2014. And I also flagged that Womenomics in Japan was not getting as much credit as it should, both for how big it would be and how positive it would be. I'm happier that my call was right than I am that Simeon's call was right, but they both, I think, are worth noting. We, of course, on average, once every 2 or 3 times have Nicholas Lardy present on his outlook on China, and at a critical period, he was making his own calls. First, that in mid-2015, that China's growth was slowing, but that there was not going to be the kind of collapse that some worried about. And then in spring of 2016, that China was going to successfully stabilize the currency and do so intentionally. Again, if you put yourself in the mindset of 3 or 4 years ago, these were very out-of-the-money calls. And I had some of our friends in the investment community saying to me, what is this with Lardy? He never changes his mind. And I reminded them, those who don't listen to Lardy are doomed to fail. He changes his mind when the data changes. And we're looking forward to publishing Nick Lardy's new book in January. Finally, relevant for today, Monica DeBola, who will be speaking, was out here very early with calls that there was the recession coming in Brazil was going to be more persistent and deeper than most had. The recovery was going to be more tenuous, and tying this not so much to the fiscal but to the financial system. And those, again, prove prescient, and we look forward to her discussion of Brazil today. And finally, I'm going to take a little credit myself. I took it on myself to talk about what was going to happen after the election 2 years ago. And you can go back and find the video. I said there was a much better chance than people thought that white women would break for Trump. And if white women broke for Trump, we would have Trump, and that would mean a huge unfunded fiscal boom and a trade war, both of which people even conditional on Trump didn't think would happen, and unfortunately they did. So this is a good product, we like to think, and the calls are just a way of getting attention. It's really more about understanding and insight and provoking a discussion. And for that, I am grateful to Karen Dinan and Jason Furman and the whole Institute team for providing us with such material. You can take down my slides and put up Karen's now, please. So let me just introduce briefly today's speakers. Professor Karen Dinan, who's a non-resident senior fellow here, is also a professor of practice at the Harvard University Department of Economics. She, of course, got better known as the Assistant Secretary for Economic Policy and Chief Economist at the U.S. Treasury in Obama's second term. She was previously Vice President for Economic Studies across the street at Brookings after a very distinguished research career and leadership and management at the Federal Reserve Board. It's been wonderful to have Karen commit to seeing us leadership through of this semi-annual exercise. Second, perhaps the most prolific person we've ever had on the Peterson Institute staff, except maybe for Arvind, Professor Jason Furman, who is a professor of practice of economic policy at the Kennedy School and also a non-resident fellow. He joined the Institute in January 2017 after his 8 years of service in President Obama's administration, including as the 28th chair of the Council of Economic Advisors, where he did not make up data. We are very proud to have Jason's ongoing affiliation and look forward to his deeper dive on wage developments in the U.S. And finally, as I've already plugged, we're very fortunate to have with us as a senior fellow, Monica DeBola, who is a media star in her own Brazil, but also is showing leadership a couple doors down the street as Director for Latin American Studies at Johns Hopkins University. Prior to joining the Institute, she was a professor in Rio de Janeiro, as well as managing her own consulting firm, previously at the IMF. And she's going to be looking at emerging markets, but in particular, of course, at Brazil, which unfortunately is very much in the news. So thank you all for joining us. Thank you particularly to my colleagues. Karen, it's up to you.
Good afternoon, everyone, and thank you for joining us, as Adam was saying. I also want to say it is wonderful to be forecasting again with Jason, because one of my favorite parts of my last job was arguing about the forecast with Jason. Anyway, this slide gives you an overview of our forecast. A year ago, when we put our forecast together, we and everybody else was talking about the synchronized economic boom. I think what's changed now is we're still expecting a broad-based global expansion, but we're definitely expecting it to be less even. So, for example, the United States is showing a big pickup in growth this year relative to last year, whereas other economies like the Euro area, Japan, and the UK are seeing a slowing relative to the pace of growth in 2017. China and India continue to grow briskly. China is seeing a very gradual slowing. That's been part of the Peterson forecast for a while now, and that's been right, as Adam has been saying. And there are special factors that are weighing on a number of economies. So that includes the UK, where Brexit concerns are still front and center, Russia, which is being held back by sanctions, and then emerging market economies, including Brazil, that are being held back by uncertainty and other kind of emerging fundamental weaknesses, which Monica will be doing a deeper dive on. Anyway, this slide just hammers home the point about the unevenness. It shows revisions to our forecast for 2018 growth relative to where we were a year ago. And what you can see, we've upgraded global growth modestly. We're at 3.8 now. That's a 10th up from where we were a year ago, but it's really a U.S. story. You see this big upward revision to the U.S. economy, whereas we have revised down nearly all the other outlooks. based on a combination of incoming data and kind of emerging vulnerabilities that we didn't recognize previously. For the U.S., the fiscal story continues to be a dominant theme. This slide shows you something about our estimates of the effect of fiscal stimulus on the economy. Of course, we had these big tax cuts, and we had the spending bill last spring, which has raised spending relative to where we thought it would be. The ultimate effects on the economy depend on what you assume about things like multipliers and spend-out rates. And so what we did is we tried to get a grip on what the relevant range would be. And as you can see in this slide, these are effects on Q4 over Q4 GDP growth. For this year, kind of we're putting the bounds between 0.6 and 0.8 percentage points on GDP growth, which is a big positive effect. Probably we're going to see a positive effect again next year, although a smaller one. And then we think that the fiscal story is going to swing to being a drag in 2020 and 2021. So you can see the fiscal story when you look at the contour of our forecast. It's an important part of that. This year, we're expecting the economy to expand 3.1% over the 4 quarters of this year before slowing to 2.3% next year, which is still above where we think potential growth is, but then in 2020, slipping below the potential growth rate of the economy. Accordingly, we are expecting a further tightening of labor markets. You can see our forecast for the unemployment rate on the left here. You can see it's bottoming out around 3.5% next year. We think that inflation will be running a little bit above the Fed's target, about a 1/4 percentage point above the Fed's target in 2019 and 2020. Okay, so with that overview, let me do a deeper dive on some particular sectors. So I'll start with households. We think the fundamentals for households remain very, very strong. So in addition to strong income growth, which is going to come out of the tax cuts and the fiscal boom, I'm showing you net worth on the left, and you can see that between rapid gains in home prices and in stock prices, the ratio of net worth to income has risen to a whopping 7. And on the other side of the household's balance sheet, the debt picture still looks very good. You can see the debt service ratio is at the bottom end of its range over the 38 years that we have data. We don't expect that rising interest rates are going to push that debt service ratio up that much because so much of debt is fixed rate mortgages. And then if you're a student of consumption, I'm sure the highlight of your summer was the revision to the saving rate, which I'm showing you here. The darker line is the current saving rate. The lighter line is the pre-revision saving rate. There was a big upward revision, and what you can see now is that the saving rate looks like it's been kind of moving sideways for a number of years now. And that's a surprise given what we've seen happen with wealth. Given the big increase in wealth, we would ordinarily expect a big decline in the saving rate. There are various interpretations. One interpretation that you see is that consumption has more room to grow. This will fuel an ongoing boom in consumption. Another interpretation would be is that there's some persistent factor that's been holding up saving relative to wealth. I think a good candidate explanation there would be kind of boomers who have not yet retired, who are realizing that they need to be saving more in order to live a secure retirement, and that persistent factor will continue, and we'll continue to see a high saving rate. But the third explanation is just that the saving rate is kind of wacky, and you shouldn't put a lot of weight on it because it's so noisy and subject to revision. So I would say our forecast is we really don't know the answer, and our forecast is giving some weight on all three of those explanations. In the housing sector, the big question is what will be the effect of rising mortgage rates? Here we think that mortgage rates are going to weigh on housing demand, but really it's going to be manifested more as a housing price story than as an activity story. And the reason we think this is just that it would appear that housing activity has been running kind of soft relative to demand for a number of years now because of supply constraints. So we think that any decline in housing demand is more likely to show up in prices. And in fact, if you look at this graph here that's showing house price growth, the thick line is year-on-year growth. Hasn't shown very much deceleration yet. But if you look at the thinner lines, which are the 6-month change and the 3-month change, you can see some deceleration on net in recent months. In the business sector, business investment has picked up. You can see in the graph, or the set of bars on the left, you can see that the pickup started last year, but it really was an oil and mining story. So if you look at the bars on the right, you can see what business fixed investment looks like excluding oil and mining, and you can see that there was no pickup last year and there is a pickup this year. So, of course, the $1.5 trillion question is how much that pickup has to do with the incentives that were put in place by the tax cuts last year, which would be relevant both to whether you expect a boom in investment to be sustained for a long period of time, but also importantly for whether the increase in investment is foreshadowing a larger supply side effect from the tax cuts than academic studies would suggest. And what I put up here, we're skeptical of this view. And what I put up here, and I'm not going to walk you through each one of them, but these are a bunch of soft indicators showing their forward-looking measures of investment. And what I want to point out here is that really all of these indicators started to head up in mid-2016. And if you look at where I've drawn the vertical dotted line, you can see that there was no discernible break at the end of last year. So all these things make us skeptical of the kind of incentives are boosting investment in a meaningful way. We just think that this increased investment has been in train for a while now. Okay. Turning to the external sector, notwithstanding all of the interest and talk about trade agreements, we actually haven't changed our story much. What you can see on the graph on the right is just that we're expecting kind of net exports to be a small drag on GDP growth in 2018 and 2019. Not surprising if you look at what's happened to the dollar. The dollar is very high. That's not surprising either, given what's going on in our economy relative to other economies. But we expect that high dollar to persist, and we do expect the trade deficit to widen. Okay, so turning to labor markets, as I mentioned before, they're getting tighter. Those payroll gains of 200,000 or higher are translating into a lower unemployment rate, as you can see on the right. The point I want to make with this chart is that even as payroll gains slow, we're still considerably above at this point, kind of the payroll gains that are consistent with a flat unemployment rate. So we'll still be above that level for a while, even as payroll gains slow. And the reason we're not expecting a bigger decline in the unemployment rate is because we are also seeing the payroll gains coming through as increasing labor force participation. So you can see in this slide that employment population ratios for prime-age men on the left and prime-age women on the right have risen quite a bit. That's one of a set of kind of welcome developments that have occurred as a result of tight labor markets that Jason's going to be talking about more. As I also noted before, we're expecting a modest overshoot of inflation. You can see inflation has already risen some. We are expecting inflation to overshoot by about a 1/4 percentage point. I want to point out that's modest by historical standards. We are seeing, or we're all hearing stories, anecdotal stories about wages increasing. I guess Jason's going to talk more about wages, but I'll make 2 points there. First of all, we've been expecting wages to increase. We're not surprised by that. And secondly, that the profit share is very high. So wages can increase without necessarily causing consumer price inflation. We should also be reassured by the fact that inflation expectations have remained low and stable, and that's what I'm showing in this chart. Okay. So, all this means that the Fed, we think the Fed will be able to continue on its course of kind of these gradual rate increases. What we put into our forecast is 5 more rate increases. We think they'll happen fairly steadily, although the Fed may take a pause as we get closer to what they think is the neutral rate. What you can also see on this chart is that the rate that they'll ultimately get to will be kind of lower than in the historical interest rate. And you can see that's true for the Fed funds rate. You can also see that that's what we're predicting as well for longer term rates. Got the 10-year Treasury on the right there. Okay, so the last point I want to make is just that if our forecast does prove to be right, the current expansion could become the longest on record. This bar chart just shows you the length of different expansions back to World War II. We've been going at it for 9.25 years right now. Another year will put us at the longest expansion, not only since World War II, but really since the NBER started kind of publishing data on business cycles. Their data goes back to the mid-1800s. So that is our baseline forecast. Are there risks? Yes, of course there are risks around our forecast, and I will highlight a few on this slide. First of all, we can see markets unsettled, of course, by a geopolitical event. That's always a risk. Markets could be unsettled by a trade war as well. If we see inflation rise more sharply than is currently expected, the Fed may need to raise rates more aggressively than is currently expected, which could tighten credit conditions and unsettle markets as well. A correction in asset prices. People don't seem to worry about that possibility right now. They think home prices are a little bit rich, but you're not hearing a ton about this risk. But of course, that's a possibility. The experts have been wrong on that front before. And lastly, I will just say that we are on the lookout for unknown unknowns, just because recessions don't follow a template. Every single one is different. So that's all I have for you. Thank you for listening to me. And with that, I guess I will turn things over to my colleague, Jason.
So thank you, and it's great to be here to talk about wages, which are probably the most important thing for the 140 million Americans that get them. Two, for those that trade on what they think is going to happen to inflation and the Fed and the like, it's quite important. And three, I think it's the smallest group of all. It's very important to economists because we find the pattern a little bit puzzling and a little bit interesting for that reason. So I'm going to go through, broadly, this is the story. There's tons of different wage measures. Some of those are so light you can't see them, but you could pick your measure. But all of them basically tell the same story. And it's a story you see there in the Goldman Sachs wage tracker, which averages a number of them together, or the measure that I'm going to mostly focus on, which is the average hourly earnings for workers aged 25 to 54, which has the advantage of taking out some of the demographic factors that a CEA recently pointed out tend to lower measured wage growth. So that's the general series that we've seen. People have talked about the wage puzzle. A lot of people have different wage puzzles and different answers. I'm going to talk about two puzzles. The first puzzle is, why is wage growth slower than it was in the late 1990s? Nominal wages were growing at 4.8% a year in the late 1990s. I'm just picking a 3-year period, but as you can see, it's not overly sensitive to that choice. Now they're growing at 3.6%. So nominal wage growth is 1.2 percentage points slower than it was back then. So I want to go through some of the potential explanations. The first thing to look at, of course, is just inflation. Real wage growth this past year has gotten a lot of attention for being quite low. It's quite low this past year just because oil prices have gone up. That's something volatile. And at some point they'll stabilize, and that's not the thing that I'd worry about over the medium and long run. If you look over a longer period of time, and I generally am going to use 3 years here to smooth out the bust in inflation and the boom in inflation, so it averages out to about the trend. Their trend inflation is lower now than it was in the late 1990s. You would expect, as a result, nominal wage growth to be lower than it was in the 1990s. So instead of having the puzzle of 1.2 percentage points slower nominal wage growth, we have a puzzle of 0.8 percentage point slower real wage growth. So one reason we're not getting those numbers like 3.5%, 4% that we got used to in the past It's just simply that inflation and inflation expectations aren't as high as they were in the past, even if this year inflation is higher. So what are some other possibilities? A second one that people talk about is inequality, something about labor markets that's making it so that people, especially at the bottom, can't get raises, whether it's monopsony in the labor markets and the like. Let me be clear, I think there's an awful lot of that. My question, though, is it explaining the puzzle that wage growth is slower than a lot of people thought it was? And my answer to that is going to be no. This is what wage growth looked like for the 25 to 54-year-olds in the late 1990s. This is what it looks like now. You see faster wage growth at the bottom than you did in the late 1990s. For the bottom 40%, you'd actually rather be living today in today's labor market than you would in what was viewed often as the canonically hottest, best labor market we have had in the 1990s. In fact, workers in the bottom quintile are seeing faster wage growth than workers in the top quintile. Now, part of this isn't because we just sat back and let, an inequality was solving itself. You've seen 24 states and the District of Columbia raise their minimum wage, and that's one of the things that's showing up there in the bottom quintile. But this represents, at least at the state level, an anti-inequality direction for policy. But then in the economy as a whole, if you look at things like the top 1% share or CEO worker comp, you see those were increasing more in the late 1990s and have stabilized with a lot of cyclicality around them. Not stabilized, growing more slowly, over the last decade. So if you're trying to understand the late 1990s versus now, it's not that bargaining power of workers at the bottom is worse now. If anything, it seems like it might even be a little bit better than it was in the late 1990s. The next hypothesis that's gotten a lot of attention is slack. It's a lot of different measures of slack. One is short-term unemployment, percentage of people unemployed 26 weeks or less. That measure of slack is much tighter than it was in the late 1990s. The unemployment rate is lower. What I'm calling U5.5, which is U6 includes part-time workers and discouraged workers and marginally attached. I'm taking part-time and dividing them by 2 because they're working half of the time. That's basically back where it was. The one measure that shows more slack is prime age employment, which I'll talk more about in a second. Before I do that, though, I'd note that statistically, there's a lot of evidence that short-term unemployment rate, that narrower measure, is the best predictor of inflation and the like. This is something Jim Stock and Watson recently found in a paper. The idea that once you're discouraged and long-term unemployed, you're going to have less of an ability to drive down and compete for wages. The people that believe the slack story emphasize prime age. That works statistically well over certain periods of time. It doesn't over longer periods of time. And the reason it doesn't work very well over longer periods of time, which gives me concern about how it would perform out of sample for making predictions, is that prime age employment is really affected by a lot of factors other than just the business cycle. If the unemployment rate's high, probably means you're in a recession. If it's low, probably means you're in a boom. Prime age employment moves continually for reasons unrelated to the business cycle. Since the late 50s, it's been falling for men. For 50 years, it rose for women. For 20 years, it's fallen for women. That's not telling about the business cycle. That's telling about all sorts of other features of our economy, and they confound its interpretation for the business cycle. And in particular, if somebody in the year 2000 had stood up and said EPOP for prime-age men is lower now than it was in 1979, that shows we have a huge amount of slack in the economy in 2000, would have thought that was sort of a ludicrous view, and that effectively is what making those arguments around prime age is now. So now the great, drum roll moment of suspense. We had a 1.2 puzzle. 0.4 of it was wages. What's the rest? It's actually the place that normally in economics we would start to understand and predict what wage growth would be, and that's productivity growth. And in particular, productivity growth was averaging about 2.8% in the late 1990s. It's averaging about 1% a year now. And so just in your standard models for wage determination, you would predict actually that wage growth would be 1.5, 2 percentage points per year slower now than it was in the late 1990s. Now, to be clear, I don't think productivity growth exactly determines wages. It strays from it for all sorts of reasons, including labor market slack, including bargaining power. But that, in a sense, sets your center point, and then you can add a bit to wages because of slack. You could subtract a bit of wages due to bargaining power. But this is a very powerful, large force that you want to center yourself around. And I'm happy to do more of it in the Q&A. There's sort of a famous chart people have shown on the left of the disconnect between productivity and compensation. A lot of that disconnect is driven by things like using different deflators for the two graphs. And once you use the same deflator for them, address other consistencies, you actually do see productivity and average wages moving much more closely, average compensation moving much more closely together than we're used to. So that's wage puzzle 1. I'll turn now more briefly to wage puzzle number 2, and that's why hasn't wage growth picked up more in the last few years? So you could think of this as wage growth in 2018 as compared to wage growth in 2015 or 2016. Going back to our suspects, inflation actually goes the opposite way. Our 25 to 54 measure is growing about 0.6 of a percentage point faster, so it's picked up a bit. But inflation has also picked up. A bunch of that is volatile oil, which is what you see in the first bar. But if you look at core PCE, trim mean, expectations, anything else, the underlying inflation rate is a bit faster now than it was a few years ago. That means if you think nominal wages haven't picked up a lot in the last 3 years, real wages, getting rid of the volatile price changes, have picked up even less. And so you've seen even more stability in real wages. So inflation compounds the puzzle. Slack compounds the puzzle as well. Every measure of slack we have has improved in the last 3 years. And in fact, people who emphasize prime age employment or U6 or what I'm calling U5.5, those have improved even more than the unemployment rate. And I don't show it here, but if you had predicted based on a 1.5 improvement in the unemployment rate, what would happen to prime age EPOP and U5.5, you would have predicted less than what we've seen. So this is disproportionate relative to the usual pattern. What's been surprising in the last couple of years isn't the decline in the unemployment, it's the increase in the participation rate. So if you believe those broader measures of slack, you would have predicted actually a faster wage pickup in the last 3 years than what we've seen. And what's important to remember is that our model, what matters is fuller employment, not full employment. A lot of people treat it as once you get to full employment, your wage inflation jumps up. There's not a lot of evidence for that. There's much more for a continuous thing, that for each percentage point less in slack, you have blank more of wage inflation. There may be nonlinearities and the like, but certainly nothing of you reach a tipping point and then your wages go up. So can productivity explain it? I think it possibly could. And what I would say is it's not that productivity growth has slowed, but we didn't realize how much it slowed. And so if you look, this is a survey of professional forecasters, 10-year expectations. They have continually downgraded their expectations of growth. So it might be that we switched to a 1% productivity growth regime a decade ago, but after year 1, we only revised down our expectations by 1/10, and then the next year by 1/10, and the year after, and we're only now realizing. And so these two forces have happened: tightening labor markets, increasing wage growth, but lower expected productivity growth, meaning employers pricing in less wage growth, and those are going in opposite directions. So I said there's a certain amount of speculation, but it definitely matches the expectations, at least that forecasters have. So to summarize, two wage puzzles, one slower than the late 1990s. I don't find that puzzling. Productivity is much slower. Trend inflation is a little slower. Of course, wage growth is going to be slower, even without a lot of slack and without a lot of inequality. Wage growth not picking up in the last 3 years. A little bit harder to explain with standard models. I think it's consistent with a slowly figuring out the slower productivity growth, but I do find it personally a little bit more uncertainty and puzzle around that one. Thank you.
Oops. I guess that's okay. Good afternoon. I'm glad that everyone by now has probably already had lunch because this is not going to end well. And I'll just say that right at the outset. So my purpose here is to discuss a little bit what we've been seeing in emerging markets, and then focus specifically at the very end on Mexico and Brazil. So just to start us off. I think all of us have been grappling with this question since May, when markets started to turn on emerging markets. Is this sort of a repeat of the mid-1990s when we saw a sequence of emerging markets just falling like dominoes one by one? Or is this really just a crisis that's restrained or contained to a few or circumscribed to a few of these emerging market economies? And here are a few sort of broad metrics by which to kind of measure and sort of get a sense of where we are. So obviously, going down this list, we look at current account balances, we look at the level of international reserves, we look at the primary fiscal deficits and what's been happening with fiscal erosion potentially in some countries, the rate of exchange rate devaluation, private sector balance sheets, how exposed are they to foreign currency, and how does that also add to these potential external vulnerabilities. The economic or the macroeconomic policy room for maneuver. So is there room to deal with the potential crises by expanding monetary policy? Is there room to deal with that potential turbulence by expanding fiscal policy or not? And finally, in red, political risk, which is something that we always have to take account of when we're speaking of emerging markets, these days more than ever, especially in some economies. So just looking at the current accounts, so I'm going to go kind of one by one, not exactly one by one in terms of exhausting that list, but starting off from current accounts, and there are 3 time periods here: 2008, which is the blue bar, 2013, which is the red bar, and 2013 is there because it was a time of the taper tantrum, and 2018. The numbers for 2018 are still based on the IMF's last WEO numbers, and we have actually been looking at what's happened to some of these current account projections for 2018, at least in the first 6 months of 2018, and it won't surprise you to know that for both Argentina and Turkey, these green bars are actually way below what is shown on here. Okay, I didn't put the 6 month numbers in because they're partial numbers, but all indicates that 2018 is actually going to be much worse than what's shown on there. But basically, the message is that if you go by the current account to GDP ratio, Argentina and Turkey have a problem. Russia doesn't seem to have much of a problem. The other countries have some level of a problem, but it's not nearly as bad as these two. International reserves, when again, the green bars are based on IMF figures for 2018. Once again, we've got the 3 years there, 2008, 2013, 2018. And if we look here, these countries, Russia, Brazil, India, and Mexico, if we use the IMF's reserve adequacy ratios, the IMF has this big spreadsheet where they calculate reserve adequacy for different countries. Russia, Brazil, India, and Mexico seem to be fine. They're above the level of reserves that they have are above that threshold of reserve adequacy. South Africa is below, Turkey is below, and Argentina is below. So here we have, on the reserve side, some red flags, at least for those 3 countries. When we look at fiscal erosion, we see clearly that there's a pattern of fiscal erosion. Again, the fiscal erosion that we see in Argentina and in Turkey is actually worse for 2018 than what's depicted here. If we're looking at those 6-month figures, pulling out of finance ministry data and central bank data, nonetheless, the fiscal erosion is already clear here. It's very clear here. Brazil has a pretty significant fiscal erosion as well, which is something that I'll talk about at the end. There's some in India, there's a tiny bit in South Africa. Mexico looks pretty good, and I'll say something about that at the end as well. Devaluation. Well, this doesn't surprise us. I mean, we know that Argentina has been getting the brunt of emerging market stress, not for unknown reasons. We know what the reasons are. Turkey has also been very much hit. But the thing that is striking, I think, about this chart is that if we are comparing to the taper tantrum, which is what I'm doing here, for a lot of these countries, the situation right now is a lot worse than it was in 2013. And that's evidently something to keep in mind because, as we've just seen in the past few charts, a lot of these countries are not nearly as robust, macroeconomically speaking, as they were back in 2013. So this is both a reflection of that. So this is both a symptom of that, as well as of potentially the lower room for maneuver that a lot of these governments have. Just to say a word about Argentina, since we're talking about the currency, we all saw that the IMF has agreed with Argentina on the new terms of a program. The program was, surprisingly for me at least, augmented by $7 billion. It's like now probably the largest IMF program given to a country. It contains a few interesting things, and the most interesting thing I found was the fact that the IMF has allowed the Argentinians to have a currency band. So Argentina now has a currency band. It's not a floating exchange rate, or at least not a purely floating exchange rate regime, and monetary policy is not being conducted through the typical interest rate channel, but rather through monetary aggregates. You might look at this and say, oh, the fund has become completely heterodox, and in fact, I've heard some of that from journalists, but that isn't true when you take account of the fact that Argentina is really a very dollarized economy. 80 to 85% of it is actually, dollar transactions. And therefore, when we're thinking about exchange rate regimes and monetary policy in a very dollarized context, you can't think of normal inflation targeting. You can't think of interest rates as your policy instrument. So that aspect of the funds program makes a lot of sense and made a lot of sense. And it's kind of the recognition of the institution that they really got it wrong in the past when they suggested that countries like Argentina and Uruguay and others, which are very highly dollarized as well, float their exchange rates. That never worked out well in any case. So this is just a remark that I thought should be made here. Moving on, this is a little sort of bingo chart to give you a bit of a sense of where we are in terms of, which are the countries that are looking very bad, and which are the countries that sort of are on the better side of this equation. I haven't said anything about corporate debt. Corporate debt is really an issue for Argentina and Turkey. It's not as much of an issue for the other countries. But as you can see here, we have red frowning faces for both Argentina and Turkey. Those are the two countries that are really in trouble right now. Brazil seems to be there sort of in the middle with a situation that doesn't look as bad. But I can tell you this. Those yellow faces, at least the yellow face right up top, the corporate debt one not necessarily, but the yellow face right up top is going to turn red relatively soon. And I'll say a word about that at the end. The green face, the international reserves, we don't know which way that's going to go because that depends on the political risk aspect that I'm going to talk about in a moment. Mexico, on the other hand, which is at the very end of this chart, is the economy that, at least amongst this group of emerging markets, is looking more solid as of now. So snapshot-wise, Mexico is looking a little bit better. So let's go into the political risk analysis of these countries, which is where we were heading anyway. So in the case of Mexico, we know that Mexico has just had a presidential election in July, as you know, there's a very long transition period in Mexico when you have these elections. So the new Congress has already taken over, but the president is only going to be in place on December 1st. So there's a very long transition period. It was the elections themselves were very surprising in the sense that it was clear that López Obrador was sort of going to be the winner, but it was not clear at all that he was going to be able to stage the kind of win that he was able to stage in the legislature. So he now holds a majority in both chambers when you take into account the other parties in his coalition. So his own party plus the others that have aligned with his party now represent an overarching majority of the legislature in Mexico. And this brings, some questions. I mean, on the one hand, the benefits of this, and by the way, this is something that is really makes Mexico an outlier in the region, because in Latin America, everywhere, what you have are minority presidents that have to govern with coalitions that are very, very unstable. And Mexico is sort of the exception to that rule now by having a majority president in place, which means that, López Obrador can actually put in place some of the policies that he has espoused during his campaign, notably some of the social programs and the social policies that he's been espousing, which are really quite important for Mexico. I mean, Mexico in many ways has sort of disconnected itself from the rest of Latin America in that it is a country that is very well integrated into the global economy. It is a country that has found macroeconomic stability and has been macroeconomically stable for a very long time. But on the other hand, it is a laggard when it comes to social indicators. It has a very, very large informal economy, and it really has failed over the last few years in implementing any kind of social program that reduced poverty or reduced inequality, unlike the rest of Latin America. So now we have a chance to do that in Mexico with a president that has a majority government. The problem is, what else is he going to do? And that's the question, because he is a majority president, which means he's got no checks on him. And he has, throughout his campaign, made some signs that he would do certain things like call plebiscites for certain things and just undermine democracy here and there, which is obviously a concern. He does have an authoritarian streak. He was, at the very end of the campaign, he was playing a different persona. He was playing a very open persona, very open to dialogue. But it's a question that we all have to watch and see exactly what López Obrador becomes at the end of the day. So the majority government may be good for reforms and for social policies, but he has absolutely no checks on his power. The recently agreed YMCA, USMCA, the recently agreed US, Mexico, Canada, can we call it a free trade agreement? I guess it's a managed trade agreement. NAFTA 0.8. So NAFTA 0.8 has at least guaranteed that for now, Mexico is not facing the risk of, an outflow in FDI and in other capital flows that have been important for its economy. But we don't know exactly how NAFTA 0.8 is going to go because we still have a lot of question marks about too many things, including what's going to happen with the political processes here in the U.S. with respect to NAFTA 0.8. So, it's something to also be on the watch for. But by and large, the message is Mexico is a country to watch, obviously, as it always is, but right now it seems to be on relatively solid ground, which makes Brazil the sharp contrast and the sharp opposite and the very dark note to this, to my presentation today. Brazil is facing the first round of presidential elections this weekend on Sunday. The elections are shaping up to be elections that people are not choosing a candidate. They're choosing who they don't want to have as a president. So the choice is not about who they want. The choice is about who they do not want. And it's because of that, it's become by watching just the elections that have taken place, both in the advanced world as well as in Latin America since 2016, Brazil is probably a case study of its own, because it is the most polarized and fragmented elections that we have seen to date. We have right now in the polls a hard right candidate, sort of the hardest right you can imagine. And on the other hand, you have a hard left candidate. Actually, the candidate himself is a moderate, but his party is a hard left party. It's the Workers' Party of Brazil. And the election has become a referendum on corruption because of the involvement of the Workers' Party in corruption, and a referendum on democracy and on the military dictatorship that Brazil had for 21 years between 64 and 85, because the hard right candidate is actually a former army captain who has, over the past several decades, up until last year, been defending the military dictatorship as one of the best things that ever happened to Brazil, which, surprisingly, a lot of Brazilians actually seem to agree with at this point. So how did we get here is I guess one very important question to think about. And there are many reasons. You all know of the corruption scandals. You all know of the dismantling of institutions that's happened in Brazil, the massive crises and recession that Brazil suffered in 2015 and 2016, the impeachment of Rousseff, which in itself was also very problematic. There are many, many reasons, but be that as it may, it's become a referendum on democracy versus corruption. And that's where these elections are heading. Bottom line here is this. There doesn't seem to be much scope for any third candidate to emerge, so it really is going to be an election between these two. And then if we try to think to ourselves, what are the post-election scenarios? What is Brazil facing post-election? Well, Brazil has a high fiscal deficit at the moment that it hasn't been able to resolve, pretty high. In nominal terms, it's around 9% of GDP. Debt to GDP currently is at 85%, going by the fund's methodology. The Brazilian methodology, of course, shows lower numbers. The debt trajectory, even if you use fairly conservative estimates, it's just unsustainable. And over the next 2 years, if nothing's done, it's easily going to reach 100% of GDP. So there is a looming fiscal crisis on the horizon, which one of these two candidates is going to have to address. Now, neither of them is likely to have the kind of majority in Congress that would be willing to go along with such a deep reform effort that Brazil needs. So I will make a call right now, and then Adam, you can hold me accountable to it. And my call is this. Since it is looking like the winner of the election ultimately, at least as of today, things change in Brazil very fast, but at least as of today, the winner of the election, whether it's this Sunday or on October 28th when there's a runoff, since it looks like it's going to be the hard right candidate, the army captain, the one that's putting democracy at risk, markets right now are very happy about that possibility because they think that the army captain is actually to be very market friendly and is going to do all the reforms that are needed and is going to do the adjustment that's necessary and is actually going to be a very pro-market, hands-off kind of person. Anyone who knows a little bit about the history of the military dictatorship in Brazil knows that that is not how the military operated in Brazil when they were in power. In fact, they were extremely interventionist. They did a lot of things through the Public Development Bank, BNDES. We're going to see that film again. They were extremely interventionist. They really got policy making wrong. I mean, this was when Brazil had its worst hyperinflation. Not its worst, it was actually worse in the 90s, but nonetheless, we had 20 years of hyperinflation when the military were in power. So the record really isn't very good. So when we think about this, idea that markets currently have that all will be resolved once we have a law and order candidate that represents, this idea that everything's going to come out fine, that just doesn't hold up. So my prediction right now is that come 2019, we're going to see significant market turbulence in Brazil, and we're going to see a fiscal crisis in one way or another. Thank you very much.
Well, as I said, the Peterson Institute Global Economic Prospects isn't afraid to make independent calls with insights based on data interpretation and political economy. I think today bears that out. We will see what proves right or wrong. I will just pick up on two things. Jason's charts on wages, of course, are extremely insightful, and we have some of his recent publications going through this in more detail. But in particular, the redoing of the chart with a common deflator on productivity growth versus total compensation, I think, is critical. We had a discussion here roughly a year ago, no, 6 months ago, I guess, with Anna Stansberry and Larry Summers, and then some people from EPI discussing that issue, but in a sense, it really comes down to measurement. Also, obviously, Monica's reminder of don't forget the human costs of losing democracy, but that democracy is also valuable for markets. This is a general principle we should all keep in mind. I will just plug the fact that Monica and our colleague Jeremy Zettelmeyer are at work on a project on economic nationalism, and unfortunately, we're getting to see some of the experiments in real time. Karen, of course, brought us to this point, and I'm grateful to her for, together with our colleagues, putting together such a great program. Okay, they've now caught their breath. This is on the record. Please let yourself speak if you wish to ask a question. Jessica has a roving mic up front. There's a standing mic up back. Please identify yourself when asking a question. And as usual, I'd like to ask that our PIAE colleagues wait a minute or two to let some of our guests speak before we turn it over to our internal debate. Who would like to go first? If no one goes first, then an Institute person will. Okay, Heather. Over there, Jessica. The mic is down. Okay. Thank you. Thank you.
The mic is too tall for me, but Heather Scott with AFP. Can you address the trade situation and the potential for a trade war and how you see that affecting the outlook for the next 2 years?
Yeah, sure. I would say, can you hear me? My mic's on. It says it's on. You hear me now? Okay. So, of course, there's been kind of more noise than there has been actual action. Our view is that given what we've had so far, not likely to see a very big direct effect. The much bigger risk is if the trade situation, in both the steps that we're taking in this country, but potential retaliation from other countries, if it were to cause an event in financial markets, to get a recession from a trade war, you would really need a spillover. For example, and I don't think this is the most likely outcome, but if the Chinese were to, suddenly devalue in response to what the trade restrictions are doing to their economy, that could destabilize financial markets and have repercussions that were meaningful for the economy. But in the absence of that, it's hard to see. It's a greater trade restrictions are a bad thing for our economy, but they're not going to cause a recession.
Can I just briefly add something to that, Heather? So we're all very much aware, in fact, we are struggling with this at the Institute, just as colleagues of ours at the Fed and the IMF and elsewhere are, that it's very difficult to integrate trade models with macro models at a technical level. That trade models tend to be very specific and have to assume closure, some kind of full employment equilibrium to allow to show the reallocation across sectors, whereas macro models, asking Karen or any good macro forecaster about a recession, are about these out of equilibrium demand forces. And so just to say, a lot of times the way people get around this is they just assume there's going to be a financial market shock, that there'll be an investment confidence effect, and there are more or less realistic and arbitrary ways of dealing with that. But we have started a project, Olivier Blanchard, Maury Obsfeld, and others. I've started a project. We're just starting to try to get better at addressing this. But this is just sort of a warning to everybody. The state of the art, not just us, but everywhere, on how to translate trade wars into macro is very difficult and is not there yet. It's bad. We don't know how bad. And I think Karen is right that if you do it honestly, it's very hard to map directly from even very chunky trade effects directly into macroeconomic swings, especially for such a huge, relatively closed economy like the US. Sorry to amplify, it's just I'm very excited about the fact that we're taking on that work and I want to put a marker down. I'm going to go to a PIE person unless someone else asks a question. Okay, that gentleman. I think the mic, unfortunately, the traveling mic is dead. If someone would like to donate money for a new mic, please do. But in the meantime, go to the back mic.
David Lynch with the Washington Post. Two quick questions. Number one, what sort of spillover effects do you anticipate for the rest of the world from the slowing of the Chinese economy, particularly for commodity producers? And then number two, if the current trade war becomes more than just a temporary commercial dispute and leads to a more permanent decoupling or disentanglement of the U.S. and Chinese economies, what sort of fallout would you forecast from that?
I don't know. Karen or Jason, do you want to tackle that?
I mean, I'm happy to. And I mean, China's slowing is a little bit like the macroeconomics of what Adam was describing about integrating trade into a macro model, which is if you look at the fraction of American GDP that's devoted to exports to China, it's not very large. Do the delta of that for China being, 2 percentage points smaller, and you get something, even smaller. But yet, whenever China slows, you see these bigger ramifications in part, as you said, through commodity prices, and the like. I think in general, and this was a theme in Karen's forecast, most every country is growing faster in the last year or two than we think is their potential. That's true of the advanced economies, China slowing as well. And so, to what degree have people gotten used to this growth rate and extrapolating it out versus expectations are already built in for all of these slowdowns? I'm a little bit worried that they're not, built in enough and priced in which case the consequences would be larger.
Monica, you wanted to add something?
Yeah, I just want to add something on Latin America specifically. So because Latin America is not a region that's been growing more in the last few years, it is probably the region that would be most sensitive to changes in the Chinese growth rate and to the effects on commodity prices, as we have already been seeing, actually. But the other side of that is that there has been increasing Chinese investment in the region and in certain countries in particular. And those happen to be the economies that are in deep trouble. Of course, when I say that, Venezuela is going to come to your mind, but I really mean Brazil and Argentina, both of which have been receiving a lot of Chinese flows, and which will likely continue to receive those flows because the way that the Chinese are investing in those economies is with a view to the very long term, not with a view to the very short term when these economies are definitely going to run into trouble. And exactly because they're going to run into trouble, they'll receive Chinese funds with open arms, which may place the region in the crosshairs of the U.S. at some point. So that's something to keep in mind.
If I can add just a moment, David. So we've had as always, a very lively internal discussion, and our trade people who've been busy talking to people like you about NAFTA 0.8 are still trying to put a hand on this. But as Nick Lardy, Mary Lovely, Sherman Robinson, and others internally have pointed out, there is a potential for a cycle where the intentional desire of the national security establishment in the U.S. and the Trump administration and some people from both parties in Congress to disengage the U.S. economy and supply chains from China leads to negative feedbacks in China, where China attacks American interests, which also then suits the Trump administration and the national security people, because then they will help push investment and supply chains out of China back, if not towards the U.S., maybe towards Mexico, maybe towards other genuinely friendly states. The implications of this over time, compounded, could be enormous, the efficiency losses. This is why I pointed out a couple months ago about the huge swing downward we've seen in net foreign inward investment in the U.S., that if you have a growing market in China, and this is what we're seeing with auto trade potentially, you have a stagnant to shrinking long-term North American auto market, you have a growing market in China and Asia, you disentangle the U.S. and affiliated Western producers from producing there, then they will simply put more production there specifically for that market because they can't afford to rely only on the domestic U.S. market. This is something where we're going to see a lot of long-term disruption to productivity and to efficiency. And this isn't small. But again, just to keep emphasizing what we keep saying, this is about the investment side, the long-term side, the business decision side. This is not really about the short-term, how it goes, because frankly, in a sense, trade, as Sherman Robinson keeps reminding us, trade always gets through. Trade adjusts actually better than investment in many ways.
Can I just add?
Please.
I just want to build on that
Arthur and then Fred.
thought with one additional thought, because I agree with you. They're important long-term costs in terms of efficiency losses. I will just say another long-term cost is this whole thing is a huge distraction, which is just kind of standing in the way and using up kind of policymakers' ability to focus on kind of real important economic policy steps that should be taken to kind of advance a pro-growth agenda.
Thank you. Apparently the mic is now working, so Arthur and then Fred.
Arthur Alexander at Johns Hopkins next door. About 10 or 11 or 12 years ago, Mike Musa was up there talking about how the U.S. or the global economy needed a recession because of the synchronized growth. The prices of materials was going up all over the world, and how we needed a recession. Well, we got a doozy after that. Kind of probably started off for the reasons that Mike was discussing. But I gather we're not seeing that today. We're getting half a synchronized growth around the world, but the other half isn't going along with it. But I seem to hear something of what you're saying, and we're getting oil prices going up. We're getting stronger than expected growth in around half the world. But I would take it that we're not expecting synchronized growth to lead to overall excess demand, weak supplies, where we need a recession in the next year or two.
Sure, I'll start and my colleagues can add. I mean, I will just say when I put up my chart showing kind of length of expansions and showed that we were getting close to having the longest one on record, if I'd had time, I would have gone on to say that expansions don't really die of old age. What they usually die of is either a shock or they die of imbalances that build up. And I'm not sure when Mike made that call, Adam probably should have put it on his list of good calls. But, certainly that was the problem whenever that was 11 years ago or 12 years ago was, in particular, we had all this leverage building up in the U.S. housing sector, but lots of other places across the economy and around the world. And those sorts of imbalances do not, there are a few places where we're seeing excesses, but kind of we don't see kind of a massive buildup of imbalances that could be threatening a recession at this point. So I don't think we're in the same position.
Thank you. Fred.
Well, my question was closely related. to
Fred
both-
Bergston from
Fred
the Peterson
Bergston. My
Institute.
question is closely related both to Karen and Jason. There is increasing buzz about a possible recession in 2020. What is your percentage forecast for either a real recession or a growth recession by 2020? I put it to both of you.
What do you remind me again? A growth recession is falling short of potential.
Significantly.
Significantly short. So I think so we think there will be fiscal drag in 2020 because we'll be coming off this sugar high. So even that said, I mean, I guess in any given year you expect there's a 15% chance of a recession. I would put it higher than that. I'd probably put it at 20, 25% in 2020. Growth recession, I mean, it's already in our baseline that will be falling at least a bit short of potential. So I think there's a greater chance than that we will see something that's materially shy of potential.
What she said.
Let me
You want to argue?
let me.
I disagree by a tenth. And
Let
not
me
sure
let
which
me
direction.
let me disagree by a half point or more. So, I think, as Karen very forcefully said and rightly said a minute ago, recessions in the U.S. do not die of old age. This is a very well-established fact. You need a financial crisis or a severe Fed tightening. For the reasons Karen said, I think neither of those are quite likely in the near term. What is at risk, where I think is where I differ a little from my colleagues, and this goes with my fiscal call from a couple of years ago, I think basically you have a 75% chance the Democrats retake the House, God willing, and if that's the case, not because I'm a Democrat, but to have a counterbalance. If that's the case, I put a better than 50% chance they make a deal with Trump to do infrastructure spending of some sort, in which case the fiscal fall off is less. On the other hand, 25% the Republicans retain the House, in which case they do tax cut 32.0 and make permanent some of the current tax cuts. Either way, I think you get a half point plus of additional fiscal stimulus that's not in their forecast. So there's basically a 1 in 4 chance you don't get that. Now, Jason has done infinitely more, as has Karen, with Congress on this than I have. So he may disagree, but he may also want to remember that 2 years ago he told me we wouldn't see the fiscal stimulus. I told him we would.
Ouch.
Sorry, next, over here, Doug.
Thanks. Doug Redeker, International Capital Strategies and Brookings. I'm curious, Europe barely was touched in any of your remarks. With the risks emanating from Europe of Brexit and Italian instability, are you basically just glossing those over as macroeconomic stories for the next year or two, or is it just too uncertain to actually project?
I mean, I think, yes, I think if we'd had a little bit more, we would definitely have talked about those two as risks. And Europe isn't immune to the bigger global trade fights involving China, the United States, and the like rippling over there, as well. So I think those certainly have far more downside potential than upside.
Anybody else? Yeah, please.
Thanks, Rick Johnson with Citibank. Monica, on the emerging markets, you talked a lot about, of course, Brazil and Mexico. But clearly the picture for Turkey is pretty dire. And then it was also interesting that your assessment of Russia is they're not in that bad a shape. I'm curious, though, if you could explain why you think Russia is going to remain in a relatively decent position vis-a-vis the others, but also, very importantly, what's the possibility of contagion? Let's say if the Turkish economy really does truly melt down, what's the possibility for contagion in the rest of Latin America if the Brazilian situation really does get worse?
So thanks for that question. The only reason I glossed over Turkey for the moment is because oil prices are doing well, and this explains most of the story. Of course, if that changes, things in Russia also change. And then we might have, again, pictures that look worse than the ones that we currently have. That being said, they do have a very healthy level of international reserves at the moment, sanctions notwithstanding and everything else notwithstanding. So at the moment, at least, we have to see how things evolve. But at the moment, at least, I don't see Russia being as critical as the other countries. Contagion from Turkey. I think we saw a few months back some signs of that when the Turkish problem just kind of popped up again, and then Argentina, which had seemed to be stabilizing, all of a sudden became also a major issue for markets, which led them back to the IMF. This is likely to, I think at least, because of the Brazilian situation, this is likely to get worse next year. And since the global environment, I mean, even though we think that, you know, the global environment is going to be by and large positive, but we have all of these uncertainties related to trade and what's going to happen to the China-U.S. trade war, what's going to happen to the U.S.-EU trade war. Latin America is completely caught in the middle of all of that because those are the main trading partners of the region. So evidently, anything that happens has an even bigger impact on the region. So I think, you know, if I were to answer this question in terms of thinking, okay, how did this situation compare to the mid-90s? I'd say that we're closer to the mid-90s than we think we are at this point.
Very clear. I think that call will close out our session. Thanks to Monica for being brave, forthright, and clear. Thanks to Jason for being brave, forthright, and clear. Thanks to Karen for being brave, forthright, clear, and well organized to get us all to this point. Thank you all for coming. Please tell your friends to go watch the video or download the reports online at www.piie.com. Thanks.